Good evening, everyone. My name is Vincent Scarsella, Director of Research and Investment Development here at Sgroi Financial. We are joined this evening by Matt Miskin. Matt is the Co-Chief Investment Strategist at John Hancock. Matt is responsible for developing John Hancock's flagship quarterly market outlook publication, which is titled Market Intelligence. This combines insights from John Hancock's global network of asset managers, independent research firms, broker dealers, and banks with bottom up fundamental and macro analysis. Matt has also been featured on CNBC, Bloomberg, Fox Business, and is often quoted in the financial press, including the Wall Street Journal, Barron's, and MarketWatch. And then prior to joining John Hancock in 2014, Matt was a manager due diligence analyst at LPL Financial Research. Matt earned a Bachelor of Science in Finance from Elon University, an MBA from Babson College, and holds the Chartered Financial Analyst designation. Matt, thank you for joining us here today. And so, going into everything right now, it's really great timing to have this chat here today with you. Powell spoke in his testimony to Congress earlier this morning and really surprised the markets with saying that the Federal Reserve is likely to lift interest rates higher and potentially faster than previously anticipated, with inflation still persisting here in the US. So, with all of that, you hear sometimes on the financial media just talks about hard landings, soft landings, no landings. But in your eyes, what do you think people should really be looking at closely to see how healthy or weak the U.S. economy is or could be heading towards?
Yeah, so it's a great question. And really, what we're seeing is the economy has been remarkably resilient. The jobs market is extremely tight. Initial jobless claims are very low. We are hearing about some layoffs, but there's still a lot of job openings, frankly. And it's hard to find work in a lot of, or it's hard to find workers for a lot of companies. So the jobs market's staying pretty tight, but there is an inflation problem that we're dealing with. And this is one of the worst inflation problems this country has faced in a long time. You got to go back into what happened during COVID in 2020 to really show where we are today. I mean, we gave away stimulus at a record setting pace, and we had supply chain disruptions, the Russia Ukraine war, and lo and behold, we've got an inflation problem. But if you look back on history, the last time we had a big inflation problem was the early 1980s. And those investors that weathered that and went through it, it created one of the best bull markets in history. In fact, from 1982, the bull market lasted all the way to 1999, basically. So we probably have some more economic challenges, or what I would call kind of a resetting a bit of the labor market and the economy. Right now, demand is outpacing supply, and we've got to get that back into balance. But if we can get inflation down, which is the Fed's number one goal right now, that leads to better investor returns. That leads to a new economic cycle. And you want to keep your eyes forward looking as an investor. And that's really what we're looking at as we get through this inflation problem that we're getting through just this year, in our view.
Yeah, absolutely. And then I guess to even piggyback off of that question, do you mind just explaining, why the Fed raises rates, why do they lower rates, and what that kind of does for the overall U.S. economy?
Yeah, absolutely. So the Federal Reserve doesn't have a lot of tools to bring down inflation. In fact, they call it a blunt instrument, meaning it's not like a surgical instrument where they can somehow just get in there and take care of inflation and not bother anything else. The other thing with monetary policy and what the Fed does, there is a lag. So what they do is they raise interest rates to increase the cost of borrowing. So those consumers that are looking to borrow for their next house, the next car, those interest rates a year ago were the lowest in history. So if you locked in a 30-year fixed mortgage rate just over 12 months ago, you could get it at 2%. Today, it's 7%. And the math behind that monthly payment is drastically different between a 2% mortgage rate and a 7% mortgage rate. Now, 90%, if not more, of mortgages across this country are locked in at those lower interest rates. There's new mortgages that are being made, but there's not a lot. But what they're trying to do is say, all right, if we increase the borrowing cost for consumers, then they're not going to be able to stretch for that bigger ticket item, that higher price point. And what they're looking to see is to have that price point come back down. So housing is the largest part of inflation. It's like 50% of the inflation index. And housing prices are up 40% over the last 2 years. And then they were down about 4% just as of late. They still likely need to come back down some more. But for them, raising that borrowing cost, raising that mortgage rate, likely normalizes that housing price and brings it back down. And if they can do that, then they can lower rates in the future. And then that likely starts a new cycle all over again.
Yeah, that makes a ton of sense to me. And then even to kind of go a little bit further into that question, you hear a lot of times too on the financial media, just a lot of people talking about the yield curve, and it's been deeply inverted for some time, and it is usually a precursor for a recession here in the U.S. So what do you think the yield curve is really telling us about the state of the U.S. economy as a whole right now?
So right now, the Federal Reserve is raising short-term rates. So how does that mean for you? That means your bank account actually gets some interest now. We actually see the bond market is offering a lot of value. We're looking 5 to 6% yield right now in the bond market as the Federal Reserve has raised interest rates. But the short-term rate is actually higher than the long-term rate, and that doesn't make sense. If you went to your bank and the bank said, hey, we're going to give you a lot of money on a short-term deposit, let's say 3 to 6 months, but we're going to give you a lower rate for a 3-year deposit. There's a thing called time value of money, meaning if you're willing to forego your money for a longer time of not touching it, you should get more interest. But right now, the bond market is kind of screwy, where the short-term rate is more than the longer-term rate. That usually does not happen long. What happens is the shorter term rate ends up coming back down because the Federal Reserve ends up raising rates and then cutting them back down. And that longer term rate actually comes down with it, but not as much. Every other time in the country's history that we've gotten one of these yield curve inversions, there has been some sort of economic slowdown or recession that has followed. But for example, the last time, again, that we saw the yield curve this inverted was 1980 and 1981. 1982 started the biggest bull market in this country's history. So again, yes, it's a shorter term phenomenon. Yes, this doesn't happen often. In fact, financial history books would tell you it shouldn't happen, or textbooks. But these periods, they usually mean a bit of volatility, and then a new cycle starts, and that's what you really want to be focused on.
Perfect. Yeah. And then even to piggyback further onto that, I think a lot of people really aren't used to seeing a negative number next to bonds. And for the last 2 years, we've seen that, which, and from my knowledge, anyways, that's really never happened in the history of the bond market to have 2 consecutive negative years. So then, kind of looking out further term with the Fed possibly pausing rate hikes sometimes later on this year. Do you see good math opportunities then in the bond market? And then can they also then be that ballast in the portfolio that really everyone is used to seeing in regards to stock market volatility?
Yeah. So in terms of bonds, what? Let's go back to the basics of a bond. What is a bond? All right. So you lend someone your money. It's a corporation. It's the government, and they give you interest payments over the life of that bond. And at the end, they give you your money back. Pretty simple, right? Well, the bond gets priced along the way of this term of however long you own it. And so over time, the bond price can fluctuate, but if you hold the bonds long enough, you get the yield, you get the income, and then the bond comes back to you. The price movement is usually interest rates. Last year, the Federal Reserve went from saying, we're not going to raise rates. They thought they were going to raise rates one time last year. And they said inflation's not going to be a problem. And boy, were they wrong. So they turned their script real fast and they were like, whoops. And so they went from telling the bond market, we're not going to raise rates to, oh my God, we got to raise rates a lot. That has not happened before in history. But what has it led to? Well, bond prices were down, and when bond prices go down, the yield goes up. And the yield is the best determinant of the forward-looking return. That is 90% of the return. Is your income stream, the yield that you get. That's what it showed historically. So right now, the aggregate bond index, which is just a proxy for government bonds, corporate bonds, and what's called mortgage-backed security bonds, that's yielding almost 5% right now. Over the last decade, that's yielded between 2 and 3%. And it's been tough. In the bond market, it's still been this good ballast. It's been a good place, to have in a portfolio for that dependable income stream, but you never had much return potential. Today, you have return potential. You have the ability to make back some of the losses that were last year in the bond market because bonds are actually now trading at a discount to par in aggregate of high quality bonds, and you're getting about a 5% yield. So if you're patient with it and you keep that income stream coming about and you wait till those bonds come closer to maturity, you can get that return potential and that income stream. So the bond market actually looks about as good as it has been in 15 years. I know it's been a tough ride over the last 12 months, but in our view, the math is very favorable. And we do think that diversification benefit can come back because right now what we're dealing with is an overheating in the economy. Well, what if in the future it doesn't overheat? What if the supply demand dynamics come back into normal? What if inflation comes back down, which is actually our call? Bonds will actually act more normal in the portfolio. And again, we think that's going to be a valuable thing to have in what could be a rockier time as we get through the next several months.
Yeah, and then to that, I mean, just we haven't seen inflation at these levels since you were saying, since the 70s, 80s. And when inflation is this high, I guess there is that argument to be made that correlations kind of go out the window. Bonds and stocks are kind of going to do the same thing. Now, with a lot of people seeing, like you were saying, inflation coming down, just another argument to be made that bonds can be that ballast in the portfolio once again.
That's right. Exactly.
So now, switching over to a different part of the market, the stock market, it already really has been kind of a wild start to the year. We had a very, very strong January for the S&P 500, and then we gave a little bit back in February. So for you, what do you see in this market moving forward? Are there specific areas that you really like? Do you like growth? Do you like value? And there's a lot of spots to kind of pick and choose from in the stock market as a whole. But really, what do you kind of see that you like the most here moving forward?
Yeah, so I'm going to start at kind of a global level. And what we're seeing across the world right now actually is the United States is emerging from this, the pandemic, the reopening, and kind of just the economic cycle as increasingly competitive. We are becoming more competitive as how we've made. I know, sometimes you live here, in the United States, and you pick on how, well, it's not perfect. There's no perfect place to live. Turns out, there's always flaws in every, economy and government, but on a relative basis, we're doing pretty well. We look at places like China, for example. China just emerged from COVID. They had lockdowns for 2 years. And what we're seeing is they're not seeing as much business development there because other companies in the world during COVID, when they called over there for their manufacturing or said, I want to have my supply chain there. Well, what they saw was that it got stuck there. And they're getting concerned that the government is becoming a bit more influential in the private sector. And then in Europe, the Russia-Ukraine war is still going on. They have to pay higher energy prices. And look, there's opportunities in everywhere in the world. There's always investment opportunities, no matter what. But when we look at China, for example, we look at Europe, and then we look at the United States. The United States looks to be gaining more and more business here. We're seeing this thing called onshoring. I know we've heard of offshoring for 20 years. I remember the Jack Welch, learning about all that. Oh, take the whole business, send it over there, do it cheaper, and then you make a better profit margin, right? Well, that mentality changed over the last couple of years. And what they're saying is, I'm going to do it in the United States, but I'm going to do it very technology driven, very automated, robotics driven, very efficient. higher end manufacturing. So, for example, semiconductors are being built in this country like they never have before. There's new plants being built all over the country. The Midwest is actually becoming one of the biggest engines of the Midwest. Yeah. So one of our global economists said this, and I was like, I've got to read this again. Becoming the engine of global growth, because what you're seeing is these states, one, they're very they'll incentivize businesses to come. They want the business to come. And then they're saying, look, we're going to build this manufacturing and we're going to make it higher end. And this is driving growth. It's driving what's called capital expenditures, or CapEx. It's driving more jobs. But again, they've got to do it efficiently. So they're doing it with robotics, so on and so forth. So where are we seeing some of the best opportunities in the US equity market? It's actually called mid caps. So the large cap space, there's parts of that that's still kind of expensive. There's stocks that have really gone up a lot over the last even 5, 10 years. And to us, the valuations are a bit rich. In the small cap space, there's companies that don't make money. They're not profitable. In fact, 40% of the broader small cap space doesn't make money. So we want to look for more profitable businesses, and we want to look for them at a bit of a discount. So where are we finding them? They're more in the middle. So that's been our highest conviction call. So U.S. equities in general, trying to find quality at a discount, which is leading us more to mid cap. And then overall for equities, we still see a bit of a chop. It's really hard to call the market direction every given day. Volatility is part of it, but we always are trying to find the best opportunities for long-term investors, and that's where we're seeing it right now.
Makes a ton of sense to me, absolutely. And then my last question of the day for you, anyways, is about the international markets. So, not many people may not realize, anyways, that the international markets, they do provide some diversification from just investing in domestic equities here in the U.S. So, in your eyes, anyways, do you believe that the international markets have a place in a portfolio? And also, if you do, what's kind of something that people should be looking at when it comes to this part of the market, whether that's a falling dollar, currency fluctuations over there. So, what's kind of your take, I guess, on the international space as a whole?
Yeah, Vinny, I think you were leading the witness a little bit with the dollar.
Yeah.
It is. It's a big part of it. And as an investor, before I studied this stuff, I had no idea about this. But when you buy foreign equities, you're buying them in a different currency. So, for example, we obviously have the U.S. dollar. The European Union has the euro. The Japanese have the yen, so on and so forth. And the dollar, it fluctuates, and sometimes it's in an uptrend, sometimes it's in a downtrend. Last year alone, this was hugely impactful. The first 3 quarters, the dollar went up, and lo and behold, U.S. equities outperformed. The fourth quarter, the dollar went down, and international equities came back strong and actually outperformed in some cases on the year because of that. This year, it's been actually back and forth. Europe has done very well out of the gates this year. China hasn't done as well, but currency is a huge part of it. And we've studied this over time, and there's usually times when the dollar's strengthening over time, and then there's periods when it's weakening over time. And it usually takes turns, years, decades, 5 to 10 year longer term windows. We just came off a 10-year run where the dollar was strengthening for much of it. And we have to be mindful that it could be a weakening dollar scenario from here. To us, that's a reason why you should have international exposure, because it means that if the dollar does go down from here, all of a sudden that international equities is going to pop back into gear. And what we've seen in the international space, year to date is, and even in the last 4 or 5 months, there's parts of Europe that had been priced for basically a depression. With the Russia-Ukraine war and the energy crisis they were going through, everything got sold off, and then lo and behold, they're going through the warmest winter they've ever had. And they've like natural gas abundance now, not abundance, but they've got a lot of it. And so their stocks have come back, and they've got a really strong healthcare industry. They've got something parallel to the United States there. They've got a very well-run industrial company complex. Some of the best run industrial companies in the world are in Europe. In China, they have a billion plus people that are getting into the internet more and more every day. So there's technology companies in China. So again, while we talk about the broad macro and thinking about the economies there as an investor, you want to be cognizant of that. But it's a lot about the company by company basis, and there's a lot of growth all over the world. There's opportunities all over the world, and you want to consider that in a broader portfolio.
Yeah, absolutely. Well, that is all the questions that I had lined up for you, anyways. And I know the feed was glitching from a couple different ends there, so I just want to thank everyone for sticking through our technical difficulties, but we made it through. And it doesn't look like any of the audience has any questions, so with that, we can definitely wrap it up. Matt, just want to thank you again for taking the time out of your busy schedule to talk to all of us here today. Very, very informative stuff. So
Thank
once
you.
again, thank you so much.
Appreciate it, Vinny. Thanks so much.
All righty, everyone. Have a good rest of your night. And if you do have any other questions, do not hesitate to give Sgroi Financial a call. Have a good night, everybody.